What's going on, everybody? Brad, the mortgage dad, here on our next road homeownership video in the series. Last time we talked about FHA loans. Now we're talking about conventional loans. So let's go through some of the features. What is a conventional loan, and maybe why it's a better product for you? So, what is a conventional loan? It's the most common type of mortgage. If you've got a really good credit score and you've got some money to put down, this may be the product you have. It's best for borrowers with stronger credit scores. So it is a risk-based product. So the better your credit, the less risk, and the better your rate. So it's also known as conforming loans. If you've heard anybody say it's a standard conforming loan, this is what we're talking about. So what are the features? Attractive interest rates. Again, risk-based product. So the lower the risk, the better your rate. The more money you have to put down, the better the credit score. This is going to be an attractive product for you. Cancelable or no PMI. So that monthly PMI payment that may be on your mortgage or somebody has talked about to you, on a conventional loan, it will either stop or never exist. So the way it stops is if you put 5% down on a loan today, once the loan reaches 78% loan to value, then it will automatically stop. Now, you cannot have PMI by putting 80% down from the get-go. So you put 80% down at the get-go, or the loan value reaches 78%, that PMI is no longer going to exist. Now, also in the environment we're in, values are going up right now. So you may hit this 78% mark a lot quicker than you would just standard value increases. So if you want to cancel it, you have to have 78%, and it's called loan to value. So it's the loan divided by the value of the house. If that is 78%, then you can cancel your PMI. If you don't want PMI from the get-go, you have to put 20% down on the loan. Now, conventional loans don't require 20% down. It's a big myth that people think you have to have 20% down. No, you can do as little as 3% down on a conventional loan. So there are some loan products out there that offer the 3% down through conventional methods, and a lot of them can be income based, some are not. That's where you need to talk to a mortgage advisor to see if this is the right product for you. So there are some 3% down options, and it can be used for investment or second home purchases. Now, you can't use the 3% down for investment or second homes. You have to put some more money into those. Talk to your mortgage advisor. A lot of different lenders might have what's called overlays or their own rules on how much you have to put down. But the standard for investment properties is 15% minimum, 25% recommended. Again, the more you put down, the less risk there is, the better the rate's going to be. So if you're looking to invest or buy a second vacation home, whatever it may be, talk to your mortgage advisor about the down payment options and kind of those pricing variances that you have. So, what are the pros and cons? So, we've talked about a few of these. There's some low down payment options, there's better rates for higher credit scores, and your PMI can be canceled or never exist. Some of the cons: higher rates for lower credit scores. There are some income limits to get the 3% down options. There are some just standard 3% down options. Again, a proper mortgage advisor is going to look at this and see if that's a better product or FHA is a better product for you. And there are stricter credit guidelines. So because it's not a government-backed product like FHA is, the lender's taking all the risk here, and so there might be some stricter guidelines on getting approved. And that's where the overlays come into place. And just in general, Fannie Mae and Freddie Mac has some stricter guidelines when it comes to credit underwriting. So you have to have a good mortgage advisor. This is where it's important to see if FHA or conventional is a better option for you. You might be on that line where conventional might be a little bit better product, or FHA might be better. So just because you have good credit and money to put down doesn't mean conventional may be the best product for you. That's why you got to talk to somebody, an expert. And then, as always, we're going to end with the pre-approval checklist. What you might need in order to get pre-approved. Now, this seems overwhelming. You can pause the video and check it out, but there's probably only 4 or 5 items on here. If you're got the standard W-2 income on what may be required. So we can go through some of those. For documents you have to get, pay stubs, W-2s, name and address of your employers, that's going to be on your pre-approval anyways, checking and savings, and then that's kind of really it for a pre-approval. About 3 items on what you may need for a pre-approval. Now, once you get into the process and actually have a contract, then more of these items are going to come into play. So, our next video is going to be USDA mortgages or rural housing loans. Either way, they can be used hand in hand. It's the same loan, different verbiage, just where you're at. And as always, Brad the Mortgage Dad here to educate you and give you the tools you need to get in the house you richly deserve. So you can contact me at bhoward@loandepot.com or go to bradthemortgagedad.com. There's a contact me. You can apply now for a pre-approval. Happy to talk to you about the next steps. If you want this comprehensive guide sent to you, I can send you a physical copy or send you the electronic copy. Just shoot me an email or contact me if you'd like a copy, and I'd be happy to send it your way. So, look forward to seeing you guys in the next video. Hopefully you found this informative. Again, Brad the Mortgage Dad. Look me up. Let's get connected and talk about getting you into your future home. All right. See ya.